look what happened is that people don't know that options put in their highs and lows before the weekly options expiration ever get here. Oh, yeah. And that's where the directional movements take place, because we'd already ran our course long before the expiration got here, because that high was put in on 2/28. That's when the high was put in. We expired over here on Friday, and the low was 249 in the high. Now, check it out. If you have 100 contracts over here for $2,500 and you're selling up here toward the high was $2.08. Let me tell you something. Even if you took $1.50 out of this side of the trade on 100 contracts on a $2,500 investment, that's 15,000 bones. Yeah, you could buy gasoline with that. Yes, you could buy the higher food costs with that as your MMT debits. By learning how to do this affords the MMT the ability, through the profit structure and the trade management structure, is to be able to address the, so what if I pay $5 of gasoline? I couldn't care less as long as I'm doing this. And if I'm doing this, do you think I care? I don't care if it goes to $10 a gallon. Doesn't matter to me. I've got a way to pay for it. And when I am buying heavier volume down here, and I'm making a top over here in the inflated. Inflated means imbalance in price action. They're both got an imbalance. I've got a deflated balance here, and I've got an inflated balance here. And moving forward, this is the last expiration. That's why I'm using this one. In the next video, though, we're going to pull up the 5, 6, or we're going to pull up the, no, this is the April. We're going to look at April, which we are, because March just went by, but the May one is a key one to look at too. So that the inline month of the April versus the outside month, that's the front line month, which is going to be May contract. And we're going to really get down to the fact of looking at both structures, and I'll just show you very quickly on this one here. So the next expiration, front line month. The inline month is now 4/16. So we're going to take a look here at, here is the May expiration $50 call. Now let's take a look over here at the May $50 put. Now, one of the things, MMTs, when this put option over here, the low was 59 cents and the high was $3. There was a great yield there based on the fact that Qualcomm had made its reversal. So we're going to look at the pricing controls here. We're going to now look at the inflated value MMT. You only got to 1030. There wasn't that much difference between the May contract. That meant that this contract truly should have went higher for the public, but it didn't. They stole premium at it, because when you go right back over here and take a look at the same high right here in the April contract, well, it's not much difference. It's 10.05, 25 cents difference in the pricing. Now, the frontline month should always be giving a normal options market, when they're not stealing from people, is that you would have a much more inflated value in the price action than what they were giving. So between the April and the May and whatnot. And you can go back over here, and I don't want to confuse you because I know I'm not, but you can take a look here. Here's your $50 put for April. And this one got to 24 cents, and the May $50 put got to a yield of 59 cents. So there's roughly, what, a little bit of a difference. 24 and 59 was the premium difference between the inline month coming up and the frontline month in May that I just showed. I will conclude this particular video, because what's going to happen, MMTs, is that by doing the 3-minute chart here with the $50 call and the $50 put up, is you're going to see where markets make their changes within the price action intraday dollar price movement. And you're going to be able to very clearly see that one side is deflated. So when we look at how Qualcomm would bounce, we take a look that the Qualcomm call over here is coming into wholesale areas now. Okay? Because it is on a 4-day adjusted triple witch options expiration. This is how they traded. They brought them down, they bounced them up, then during Friday expiration, down they went. So the $50 call and the $50 put, the inline month, and then understanding the outline, the front line month, which is going to be the next month out of the inline month, the front line after the inline, is going to be that you're going to see the adjustments between the two different months of as far as premium goes. And the thing about it is that we are going to hit where they're going to take possibly, if we drop down on the gap in the morning, naturally this call is going to come down, and I'll have you set your alarms right now. After I come off the video, then we're going to set alarms. I'm not going to do that on the video. You're going to set the alarms in your direct access platform next. I'm going to conclude the $50 call, the $50 put, the April, the May, right along with directional price movement, long and short, and what the depth of the long side of the tape versus the left side negative ratio versus the positive ratio, so that we can get a balance of the price equilibrium, okay, of where we're going to be holding. And everything that I showed you earlier on QCOM on the other videos, weekly, daily, and all of that, and the weekly indicators and everything, is going to be a big process between the QCOM $50 call and the $50 put. And when we get really super wholesale over here, QCOM being a leader, it's not affected by Japan right now because all of their business comes out of Taiwan. Okay? And the thing about it is, from a fundamental perspective and a, human event, the public perception is to steal this side of the market, to buy it as cheap as they can, and inflate this side of the market as much as they can. So when this side does get inflated, this side's going to get deflated, but the bigger side of the trade is going to be just the opposite. It's going to be buying this side of the market. Okay? And how are we going to monitor it? Well, we're going to do everything that you were taught. And everything that you were taught about how to use this daily chart, you were taught everything about the weekly and the intraday, and you were taught about where those market maker lines are going to drop down. This is a mathematical market maker machine. It calculates it all for you. But when we do gap up, they're going to steal the put, or if we gap down tomorrow, they're going to steal that call. And the first order is to buy the equity long, and then MMTs is how I buy this call wholesale, because the call's going to go up in value. So if the call's going to go up in value, well, you got to be long the name too. You get paid 2 debits on this, on the trade. So you get this wholesale, you buy the equity, and you buy this. So you'll have the equity price up. You'll hit the buy button at the wholesale bid. Then you'll let the equity burn off the bottom. You'll let this go up in value. You'll hit the sell button when this gets to the top. And when this gets to the bottom, which this will come down, and when this starts to move off the bottom, then we're going to put the top in, and you're going to know to sell. But you're also going to use your 3-minute chart between the buyer and the seller, and making markets between equity and options and directional movement, long and short, because a put is when it goes down in value and a call is when it goes up in value. MMT, I've been given a gift.